first rates, just bear with me. I'm just going to load my Bloomberg screen to get the first rates. I go Nifty up 21 points, just 21 points, 15 points, 96 points up for the Nifty. Bank Nifty just not going anywhere. So we are just off to a very, very flattish kind of a start. City Network, 1 rupee stock 3% higher. Yes Bank, 16 rupee stock 0.5% higher. Adani Power, 4% higher. You've got 2-3% higher for just very small stocks actually. Nothing which is even catching my attention. So Adani Enterprises down, Adani Power up. Cipla down because of that news development, 5% lower for Cipla. Adani Transmission down 4%. HDFC Bank flat, Reliance flat. Just it's a listless market, Aman. I mean, I can endlessly talk about it, but yeah, that's the screen.
Yeah, really struggling to find, any decisive moves on the upside at least. But let's take you through the newsmakers. That FTSE semi-annual review inclusions from the global large cap index include IDBI Bank, Union Bank, Indian Hotels, Shriram Finance, ACC, Kotak Bank among the lot. Exclusions 197 or Paytm, Biocon, Godrej Properties. And some interesting key inclusions from the mid-cap space include APL Apollo Tubes, Patanjali Foods and Vedant Fashion. So watch out for those three stocks as well in today's trading session. Yes, you do have Cipla, which is reeling under pressure. Just want to quickly revisit that name. Remember, the US FDA has issued 8 observations in Form 483. This is for their Indore manufacturing facility. Stock continuing to reel under pressure. Samvardhan Motherson has acquired SAS Auto System Technic for an EV of about 540 million euros, so watch out for that. United Breweries, the MD and CEO resigning. The Supreme Court as well has stayed a penalty of about 750 plus crores. That seems to be putting the stock in a little bit of a spot. Sun Pharma, meantime, acquiring minority stake in companies for about 180 crores. Minda and Precall, you've got Minda buying about 15% stake in Eidos Minerva and selling their Precall stake. Bandhan Bank, Biocon as well. Remember, they're going to be excluded from the Nifty 50 index, and ditto for Emphasis, Gland and Paytm. You've got Power Grid. They've been a successful bidder in interstate trans systems, so keep an eye out on that counter. And something like KC International, it's been a massive order win of about 3,000 plus crore rupees, one of the largest. And RITES has bagged new orders worth about 76 crores, so watch out for that. But Kunal, pretty much moving according to script. Yes, the breadth is in favor of the gaining side, but really struggling to find any names, right?
Yeah, struggling to find any major trends on the indices. Stock specific, yes, there are a lot of stocks which are looking attractive. Reliance Industries continues to be a stock which I would be bullish on. I think at 2,400 levels, 400, 420 approximately, I think is a good zone to buy the stock. So would maintain the bullish stance on Reliance and probably would up my targets from 2,500 to now 2,550, 2,580 mark.
Okay, Reliance Industries it is. That continues to be on Kunal's radar. I just want to quickly check in on where that stock is currently at, 2443. Let's move on then. And Nooresh, what's catching your eye this morning?
So taking a risk reward trade on Wipro, wherein at 403, that looks like a stock which can bounce back going forward. So keeping a strict stop loss at 398. Apart from that, nothing much in the markets. It's almost a flat market across all the indices.
All right, let's move right on then to the big market voice to understand what the outlook is for the year ahead, whether or not we can repeat the 2022 outperformance. And Aisha's in conversation with Vikas Pershad, Portfolio Manager, Asia Equities, M&G Investments. To you, Aisha.
Thanks very much for that. Yes, today to get the FII perspective, given the India underperformance of late, who better than Vikas Pershad, who manages billions of dollars as part of the India Fund, although I can't quote the exact figures, to talk about how he's viewing India right now. Vikas, welcome to the ET Now studio after a long time. Why this underperformance? I mean, relative, but in the last 6 months, especially vis-a-vis what the other world markets are doing, and especially the steep recovery in China and Hong Kong. Does that come as a surprise?
So I'll answer the second question
Sure.
first. It's not really a surprise. I think if you look at the significant outperformance of India, and I'll put Indonesia in that also. So you look last year in what was a very tough market for markets globally, across asset classes, Indian equities performed quite well. I would say the Indian fixed income and the FX also performed pretty well. Indonesia, same thing. Now, to focus on India, the absolute performance was positive in a tough year. The relative performance was even greater compared to the rest of the world. I think it would be unreasonable to expect relative performance to continue this year. But I think India remains the most exciting market for equities in Asia, if not the world. And the long-term story remains intact.
Right. While the long-term story, you say, continues and is going to be intact, will the outperformance of other markets continue while India's relative underperformance continues? Will China, Hong Kong be the markets which everyone is going to rush towards?
They can. If they do, they're welcome to do that. If they're selling India, we'll be buying. We're here. And I think if you look at China, Korea, Japan, these are all markets that we were very excited about. We invest across the region and around the world. But India, our allocation of capital, the firm's allocation of capital to India has never been higher. Our levels of cash in the India dedicated funds have never been lower. So if there's any way to express our constructive view on India, I think that's one way to do it. Short-term absolute outperformance should still be strong for India. Short-term relative outperformance, hard to guess. But in the very long term, I see few markets in Asia that outperform India, even in dollar terms.
Vikas, it's interesting that we're meeting right now because of late, with all the ongoings with the Adani saga and a lot of other things, to how a lot of global commentators as well have been watching this entire episode play out. Is there a doubt on the India story at all? I mean, do you get questions and queries sitting out there in Singapore regarding what's going on with the Adani names?
Yes. So that's part of the reason I'm here, because a couple of weeks ago, I started getting questions like the ones I got last summer and autumn. Last year was, is China investable? Are you allocating more money to China? 2 weeks ago, it was, is India investable? Is the India Inc. story dented? Are you allocating more money to India?
And how do you answer that then?
Well, I'm here to answer those questions. And when I start getting questions like that, it gives me a signal that I should be doing the opposite of what others are saying. And as I mentioned, our allocation of capital to India has never been higher. Our cash levels have never been lower. And so I also think the opportunity set in India has never been broader, it's never been deeper. When I was here, last time I was here in the studio was 11 years ago. At the time, if I share some numbers, so Reliance, HDFC, TCS, and Unilever, aggregate market cap was about $200 billion. Just those four companies, the aggregate market cap today is $500 billion, in local currency terms even higher. When we look at how the Indian GDP will grow, how the story will play out over the next 11 years, 12 years, those numbers will repeat themselves across sectors again and again and again. And so we're very excited about this market. There's no kink in the India Inc. story.
So suffice to say that you've been a buyer, bought more of the same, added more positions in the recent underperformance or the decline in India?
Yes, across key sectors. So I think there's a guess just on, if we start with healthcare, for example, I think the Indian healthcare story is intact, very strong. If you look at hospitals, services, some pockets of biotech and pharma, I agree with the view on diagnostics. If you look at IT services, the larger companies, it's not as bad as people think. If you listen to the commentary, if you look at the numbers, revenues are healthier than people thought. Margins are higher than people thought they would be. Banks is one area where we prefer some of the smaller and middle-sized ones, specialty finance, housing finance, not so much the big banks. The scale is such, you have to be more careful. Autos have surprised me, four-wheeler and now two-wheelers. I think those are fertile grounds for long-term investors. We can keep going, there's a lot to talk about.
Yeah.
But I think the point is that if you look over the past 2 decades, there have been so many episodes where you have gotten these questions, I have gotten these questions. If you think about May 2004, May 2009, when the election results were surprising. 2013, the summer, yield curve inverting, currency blowing out, same questions. Global financial crisis, COVID. But the market endures because the earnings growth story is so strong. There are other markets where there's a short-term trade. This is not one of them. This is perhaps the longest dated trade in the world when it comes to equities, and we're here to be a part of that.
It's interesting that you say IT is not as bad, so clearly you're not concerned about US recession. You feel that that's going to only spell more business for India services?
I think it's fair to say we were more concerned about that 12 to 15 months ago than we are today, and the portfolio is positioned for that. Also, the prices reflect that. So if you look at the starting point today compared to the end of calendar 21, the starting point is so different. And there's a lot, what we're trying to judge always is what is in the price and how do we allocate our capital to maximize prospective returns. You look at IT services over the past 15 months or so, and a lot of those concerns are in the price. Now you start looking at the numbers, and relative to expectations of just 3 to 5 months ago, the earnings delivery has actually been quite positive across the sector and concentrated in the larger ones.
What intrigues me, on the other hand, is, and sorry to jump to not what you don't like, private banks. What makes you so wary of private banks?
I think it's less an absolute concern about the banks, more just a relative positioning and where the relative returns are. So I think if you look at the size of the loan books and the growth that is priced in for them, in percentage terms, these numbers are high, but in absolute terms, it's so large. So where we see better opportunities, not that we don't have good opportunities, we have good opportunities. Where we see more and better opportunities are in some of the smaller companies, housing finance. If we look at housing finance for the lower and middle income groups, I know there are some sectors in consumer discretionary, consumer staples, where if you're exposed to the mass market, there's some concerns, and we can talk about that. But in housing finance, I think that's a very long-term story for growth, and we have our capital there.
Well, how can you be bullish on India and not bet on the big banks, right?
Yes. So it's more a relative bet. So if we look at the aggregate exposure in the big banks that we have today, relative to the rest of the portfolio, it's a little bit smaller, but it's still quite overweight. So we still like them, but we like other things more than we did a few
More the
months back.
corporate-facing banks?
More the corporate-facing banks, yes.
Okay. And I'm going to now jump from IT to the sort of, the fancied IT names, all these tech companies, the new age tech companies, so to speak. And I recall your comment that, you weren't as smart as an Alia Bhatt or a Katrina Kaif when you actually skipped Nykaa.
Yes.
But in retrospect, I'm sure you feel happy about giving those names a skip. Having said that, now that they seem to be on the path of profitability, talking it, delivering it, as did a Paytm, are you now exposed to them, or is it still zero exposure?
So our aggregate exposure to the class of 21, class of 22 tech IPOs is still effectively zero. You can have an issue with a company's valuation or the business model itself. For us, for many of these companies, the issue was not the valuation, although it was that also. The primary concern was the business model itself. And in a world of rising competition, pricier capital, what do these companies do? How do they evolve? And what we've seen in the earnings delivery, or there's not much earnings, even in the revenue delivery, is that our concerns have been justified. And despite the correction in the share price, there's not much value there yet. So there's a small subset of these companies that we keep our eye on, but our aggregate exposure is still effectively zero.
None of it? No Policy Bazaar, no Paytm, no Nykaa, or maybe the unlisted space as well?
Well, so I'll talk about the unlisted space,
Sure.
because I think there are certain areas in B2B e-commerce, in infrastructure build-out, in manufacturing, and in two-wheelers, where we are actually quite excited. Our allocation to new private companies in 2022 was zero. And this year, however, we're making progress, we're doing diligence. It's another reason why I'm here, to meet some of these companies. And I think that story in particular is very exciting, but there's a broader story around that of manufacturing in India that we can talk about. That is very exciting. And so yes, if I look at what could be the class of maybe 2024 or class of 2025 IPOs, the companies that we're looking at today are very exciting, and there's a high probability that we allocate capital there.
Okay, fair enough. I also want to talk about autos, because 2 years back when we chatted, you were completely bearish on two-wheelers,
Yes,
right?
yes.
The stock prices definitely have underperformed, whereas you've got the class of four-wheelers doing what they have, everything from an M&M to TVS Motors actually has been an exception in that pack. But are you bullish now overall on autos, or again, is there diversification, four-wheeler separate, commercial vehicle separate, and are you bearish or bullish on any of that?
I'm glad you remember everything, because it makes me look good. But yes, so the two-wheelers did underperform.
Yeah.
I think that, so I'll address that, but there's a broader question. Why we like India, the breadth and the depth of it, is because for almost every sector, you have so many choices. And for active managers, it's a wonderful market because there's such a dispersion. We'll talk about autos in a second, but IT services, banks, healthcare, manufacturing, staples. If you look at the share price divergence, which is a direct function of the earnings divergence over the last couple of years, it's quite material. And today, when we look at two-wheelers, to come back to your question, we expect that divergence to continue. So when we last spoke in November 21, 15 months ago, our effective exposure to the two-wheelers was close to zero. It's not zero any longer. There are some underweights or shorts that we have closed, and the work continues. The work that we are doing on the private side is informing the work on the public side, and vice versa. It's making us smarter on both sides. So the two-wheeler story, I think there's partly because of the pent-up demand, and also because of the shift from these ICE vehicles to EVs.
EVs, yeah.
Yes, and the opportunities that we see, actually the private companies have surprised me to the positive. And the listed companies, I think I would have expected more from them by now. But they can be fast followers. We've seen this in other industries where the incumbents allow people to burn a lot of money, develop products, and then with their scale and their size and their acumen, then they come and they eventually take the lead. That could still happen. This race is not won. We're still closer to the beginning.
But are the
than
ones
end.
who are going to catch up on the EV race going to be the fastest ones to win?
You mean on the private side?
No, across the board, four-wheelers, passenger vehicles in
yes.
particular.
It's very interesting. I think if you look globally, the adoption of EVs has exceeded general expectations, certainly mine. I think that I read a stat recently that EV sales have crossed $1 trillion for the first time globally. And if you look at the penetration rates, two-wheelers, four-wheelers, CVs, scooters, personal mobility, all of that is accelerating. Related to that is the component technology, the component industries, the battery industries, energy storage, energy charging. And a lot of those roads lead back to India, China, and Korea, which is why I think those areas are worth looking at as well. And these stories will take a long time to play out. So we'll be able to invest in the space for a long time.
Sure. You know, the other space that you've talked about is the derivatives of housing,
Yes.
everything from home finance to tiles to paints, etc.
Yes.
Having said that, while the boom in the real estate sector was a big move. You know, it was almost an alpha generation if you bet on the housing sector at the COVID lows. But it's not been a very symmetric rise in the entire space, right? Be it derivatives or pure play realty.
Yes.
How are you exposed to the real estate sector at large right now?
So in our portfolio, the implicit bet on Indian housing as a story is perhaps the largest aggregate bet that we have.
Oh, okay.
Now, within that, what's curious is we don't own any of the developers. Our exposure to the developers.
Why is that?
I think there's more operating leverage and more gearing to that story in the derivatives. However, I'm actively reevaluating because after the sustained period of underperformance, which I think we had hoped for and expected, but not entirely predicted, it's worth looking at them again. Now, if you look at pipes, fittings, ceramics, paints, adhesives, all these other things, and then you layer on top of that housing finance, we can only invest in so much. But there's so much going on here. You listen to their commentary, you look at the revenue growth, and it's not, the revenue, as you know, is a function of both price and volume. Volumes are high, and we know they're going to be high for a long time. The pricing has been more resilient than we would have expected. And on top of that, these companies have been very intelligent about the operating leverage. But again, this is another one of those sectors where you can't buy everything. You have to do your homework. But the dispersion is there, it's available, the alpha is there.
When you say you're betting on India manufacturing, you know, a lot of sectors are now opening up. There's defense, there's railways, etc. as well. Are you skewed towards largely auto manufacturing, or have you also broadened your portfolio?
That theme is more broadly reflected in the portfolio than it has been ever. So it is infrastructure, it is defense, it is anything associated with rails is exciting to us, and we're spending time on that. It's two-wheelers, it's four-wheelers, it's commercial vehicles, there's agriculture equipment. All of that is reflected in the portfolio. And I think this is just, we're closer to the beginning of the beginning than the end of anything when it comes to this shift. Because there's the domestic demand, there's China plus one, and there's also, and that China plus one is not confined to any one sector. You're going to see that in healthcare, you're going to see that in clothing. Over the longer periods, you might even see that in semiconductors, although I think that's going to take a lot of time and a lot of capital. So we don't need to talk about that today, but it's going to happen again and again. It's actually quite exciting to see. I confess I was skeptical 2 to 3 years ago about this because you look at the power infrastructure, the logistics infrastructure, and I think any rational person would think this story is going to play out over a longer period of time than expected. But you look at smartphone manufacturing and all the other sectors we just mentioned, it's all happening. It's quite real. It's very exciting to see.
So this is all the good. What is it that you dislike about the India market?
As a market as a whole, I think, okay, well, let's start with valuation.
Yeah.
Well, India is probably the one market where we are least dogmatic about valuation. We have learned our lesson decades ago that if you just buy the lower PE, lower PB stocks, in absolute returns, you won't make much money and you'll horribly underperform. So we're not dogmatic about valuations. I would say as a broader market, and for many of the companies we've talked about, or sectors we've talked about, the valuations are pricey, not expensive. There's a difference, right? Expensive, there's risk to your capital. Pricey, it's because that's where the earnings growth is. So broadly, valuations, I'm not so concerned. Now within that, you look at some retail companies, consumer discretionary companies, some of the healthcare companies, those valuations are genuinely expensive and we're staying away.
Rakesh Sharma, Executive Director with Bajaj, also joins us now. Let's take our conversation forward with him. Mr. Sharma, good morning. Thank you for joining us. Things are looking up, sir. Margins are better. Market share gain is picking up. The impact of commodity prices clearly seems to be behind us. So looks like after a mixed 2022, you are in for a decent and a strong 2023.
Yeah, morning. Indeed, things are much better than what they were 6 months back, both from the point of view of the demand coming back. There was a reasonable festive. There was a little dip after the festive. But now it does seem that the industry, after a long time actually, will be in the positive zone for the coming, let's say, 12 months. The three-wheeler business is also coming back rather nicely. You know, it's almost back to its pre-COVID levels. And penetration of CNG has improved. So where we enjoy a very, very high market share of 80% plus, it's a very profitable segment. So that's come back rather nicely. We still have some headwinds, as you know, in the international business, thanks to the volatility around the dollar. Both the devaluation and the availability of the dollar is a big handicap for international business. And in one of our largest markets, Nigeria, elections are coming up. So that's usually a tumultuous period for Nigeria. So we are looking at about probably 3-4 months more of an unsettled scenario in the international markets.
So could it be this versus that? When I say domestic will pick up, export will remain subdued, net impact would be neutral?
Yeah, it's difficult to be precise about these things because the one upside on the international side is that we keep gaining a little bit on the soft devaluation of the Indian rupee, which is happening. So that keeps adding to the bottom line. Some of the markets like Latin America, where we sell premium products, those have started to respond well. But overall, you're very right. The international business outlook, at least for the next 4 months, will be down. Domestic will be up, but let's see whether they are completely able to offset each other.
Please say that worst of the margin pressure is behind us, and if commodity prices come down, you're not going to cut prices, which means that the price hikes which you've taken will be retained, and that will automatically boost your margins now?
Yeah, I suppose so, but there are some indications on the aluminum side, etc., which is suggesting that there might be some uptick which we will see. So we will wait and watch, but generally it's a steady situation right now.
Touch upon the domestic situation, but I want to delve into it a little bit deeper. Given the fact that we've seen the demand for the 125cc and above that remains steady, the entry segment demand is a little bit tempered in comparison. So any green shoots that you're seeing?
See, overall, I think that the industry has moved up quite smartly in the last 2-3 months. I'm not saying that it is rocketing up, but it is like a gentle positive, single-digit positive. And hopefully, as the mini season in the north unfolds in April, May, it will move up further. So the entire industry is moving up, which includes the entry level. But if I divide the market between 125cc and above, which is almost now 50% of the Indian market, and the lower half, then the upper half is outperforming the lower half by 3 or 4 times. So that is the kind of difference, and that is the reason why the 125cc plus segment, which was a couple of years back in FY20 about 45%, is now today 50%, and this is a trend we see that as continuing. So the entry, which is the first motorcycle or the most affordable motorcycle, that segment is indeed, trailing way behind all the other segments.
Okay. You've gained market share, and is this a function of any scheme, new launches, or this is pure on merit?
Well, everything is on merit. It's just that, which type of strategy and tactics one deploys. Uh, we have not run schemes really even through the festive to now, because our whole approach has been in rejigging our portfolio. And if you see, our flagship brand Pulsar is gone for a complete makeover, which started in somewhere in June of last year when we launched the new platform with the twin 250 cc's. There were two models of that. And then there was a 160, and then there was right now a 150 cc. So the entire thing is completely changed, and large parts of that portfolio are very, very happy that they've got excellent traction, and we think they're getting more youthful and newer customers to the Pulsar franchise. We had also extended the Pulsar brand, and that exercise started 2 years back with the 125cc, where we have got three or four models to suit different kind of tastes. So now if you see from the 125cc to the 250cc, that spectrum, we've got 20 models over there. And I think the nearest competitor has 13 models. So because of this, we are gaining share and gaining traction, new customers in geographies where we have been weak, in sub-segments where we have been weak. And this has also resulted actually in the improved ASPs and slightly better margins. So the contribution of to our EBITDA margin, a lot of it, I would say about a third of it, is also driven by the shift of our portfolio to the upper half of the segment on the basis of new products. We have also recently launched the Platina 110 with an ABS, which is the first of its kind at that level in the world. And this is an attempt with a very, very solid feature and a very solid proposition, which is top of the mind for every commuter, which is safety, and to upgrade the customer on that basis. So the approach has been very, very heavily product-led with solid propositions where there is something which is very, very differentiated and unique, which we can go and engage the customer with. So I would say that the market share gain and the margin gain, both have been driven largely by a product-led strategy.
Which markets always look forward to is that what is the product pipeline for any auto company, whether it is four-wheeler or two-wheeler. So for 2023, what is your product pipeline? I mean, how many new launches, new platforms, new variants would be at play?
Well, I obviously cannot be very precise about it, but this pace which we have been maintaining over the last 1 year, which you see that every quarter there is a couple of new products which are introduced. I can tell you that this is going to continue. This is going to continue right from the entry-level commuter end, and right up to, I would say, including the Triumph brand, which hopefully in the next fiscal will make an appearance. So it's a very rich product pipeline. That's the theme of last 1 or 2 years, where we were working on products, and that will find expression as we go forward in the next fiscal.
In 3 years from now, do you see electric vehicles or electric two-wheelers having a significant and a dominant presence on Indian roads? I mean, there was a time when we discussed EVs in the four-wheeler space. There was a lot of yes, no, I don't know kind of a narrative. I live in Mumbai, and every time we go out, we can see cars with green number plates now. Do you see that phenomenon could be at play even with two-wheelers? It could not happen this year, but it surely will happen in 3 years.
So you're talking about two-wheelers or
Yeah,
three-wheelers?
I'm talking about two-wheelers and three-wheelers. I mean, three-wheelers is the migration is evident, but for two-wheelers, do you see electric two-wheelers having a dominant market share in 2-3 years?
No, I think that the whole migration is actually far more evident and stronger in two-wheelers, particularly if you look at it in the context of how in scooters. Now, almost 20%, I would say in December and Jan, if you take the latest numbers, 20% of scooters is high-speed electric two-wheelers. And this is an average. So there are certain cities where it has gone up to 40-45%. And this is a very high level of penetration. Of course, it is tapering down if I compare it with 6 months because of the base effect. But I think the customer has made it's seriously, a two-wheeler is in serious consideration whenever a customer steps out for purchase. And the driver for this migration is, of course, the petrol price crossing 100. I think that was an inflection point. But the driver remains to be a very functional reason. It's a very economical reason, primarily, the savings. And, of course, the convenience of not going to a petrol station. So this is a very strong driver. Now, the only thing which can drag the party down is the cost and the subsidy, because we all know that this proposition, which the customer is finding economically very attractive, is supported a lot through subsidies. And I doubt if anyone expected that there'll be such a boom in two-wheelers. The subsidy bill has obviously increased, and we are waiting to see if that continues. And on the other hand, the cost of the raw materials, which had been primarily lithium-ion based stuff, which had been declining for about 5-7 years, thanks to the demand and supply imbalance, it has started to rise. So if through a combination of rising costs and reduced subsidies, if this proposition, the economic proposition, gets dented, then this adoption might slow down. But at this point of time, the adoption, the cannibalization of ICE scooters is very strong. It's very strong in a few places which have reached maturity, and it is unfolding. In three-wheelers, it's a very different segment where people are not using it really for personal purposes. It's a completely commercial game. And there is CNG. The economics of electric versus CNG are not so strongly in favor of electric as it was in two-wheelers when you compare it with petrol. And the government has done a fantastic job in spreading the CNG network. Now, 50% of the country is almost covered with the CNG network. Another 4,000 pumps coming in the next couple of years, which will take the coverage to 80-90%. The three-wheeler driver is very familiar with the operations of the CNG. They don't have the same anxieties of range and all those things. And the adoption of CNG three-wheelers away from diesel three-wheelers happens very, very easily. So the issue of range anxiety coupled with not such a big economic differential is causing the migration in three-wheelers to happen at a lower rate. So we have to go and work on the drawing board, make the proposition stronger on both fronts, the economic front, as well as the issues like range anxiety, which in a commercial situation becomes very, very important. We have to do that and then go back to the customer and make sure, and hopefully then that will drive the transition.
Appreciate your time. Thank you so much for joining in, Mr. Sharma, and giving us highlights on business and how the industry as well is operating. We'll take a very short break. Stay with us. When we come back, Ajay Patil, the CFO at Cummins India, joins in to talk about the very healthy quarter gone by. Welcome back. Still tuned into First Trades. Let's put the spotlight on Cummins India. Recently, the stock scaled its life highs, and that's largely on the back of a pretty positive set of Q3 numbers. There was a strong operational performance as well, and the street clearly gave the stock a huge thumbs up. So let's talk about the road ahead for Cummins India. Ajay Patil is the CFO who's now joining us on the show. It was a nice positive surprise in the quarter gone by. It clearly beat all analyst estimates. But the question is, Mr. Patil, given the fact that we're looking at a pretty strong demand environment in terms of domestic as well as exports, do you think that this trajectory is going to continue? What's your guidance when it comes to your margins?
Hi, good morning to you as well as all the viewers. Indeed, I think quarter three was a fairly strong quarter for us. And you would have seen that generally speaking, quarter three among the 4 quarters is generally the strongest for us. And this turned out to be true for this quarter as well. Obviously, both the domestic and export segment did really well with respect to the quarter. We see fairly steady demand from a exports perspective. When you look at the 9 months numbers for the exports, I think our high horsepower and low horsepower businesses in exports market grew almost 14 and over 40% in the low horsepower segment. And we have seen demand growth across all the geographies, right from Europe, Latin America, Middle East, Africa, and Asia Pacific. Now, having delivered a very strong quarter, which is generally the best, as I said earlier, I think our endeavor is now to continue to sustain the growth momentum as we see the end markets, both at domestic and exports, holding up. The only caveat is there is still a bit of a supply chain constraint that we do see for a few electronic components. If that eases up a bit, I think our ability to deliver strong growth in Q4 is what we are working towards.
So if I may reiterate then, in light of what you're saying, the fact that you are looking at a strong improvement, margins then we can understand will grow from the current levels?
I think, we haven't given a guidance, just to clarify myself, but our endeavor, as you would have seen in our commentary, which is very consistent over the last several quarters, is that we continue to find ways to expand our margins. We do believe that the lag effect of pricing, softening of commodities, and the volume leverage, when you put all of these three things together, should be in a position to sort of sustain or improve the margins. But just to reiterate again that this is not a guidance, but just our endeavor to see that we continue to work towards a profitable growth.
Now, Mr. Patil, going forward, what's the outlook when it comes to your order book? Do you think that Q4 will be better versus the historical growth that we've seen?
I think when we exited quarter three on a fairly strong order backlog as well as order board, as I said, we are still what we call internally a word called managed demand, which means we are not able to 100% meet the demand simply because of supply constraints. Keeping that in mind and our focus on execution as well as easing up on some of the constraints on the supply chain side, we do believe that on a year-on-year basis, we should be in a position to sustain our growth, what we have seen in the previous quarters.
Okay, that's the view coming in. Let's also understand the outlook when it comes to just wanted to take a look as to what the outlook is when it comes to the hike that we've seen, a 35 to 50% hike on power generation equipment. That's largely on the back of the implementation of the CPCB4 norms. Will this cause, a margin blip? Will the hike be able to actually convert your costs?
I think the CPCB4 plus norms for a particular range of diesel generating set is effective July 1st, 23, as we all know. So therefore, all the older emission engines can be made up to 30th of June. However, the gensets can continue to get another period of 6 months from July to December in order for them to continue to sell genset at older emission norms. What we have typically seen is a transitionary impact when we are looking at, let's say, the quarter 2 or quarter 3 of the current year. That is where we'll see how the transitionary impact could be. That's number one. Number two, from now till June, potentially as a consequence of this, historically we have seen some kind of an elevated order position. We'll have to wait and see how that kicks in, whether it happens in the current quarter or it gets into the quarter one of the next year.
underline that supply chain constraints pose risks to the near-term outlook. What kind of measures are you undertaking to be able to counter this?
Yeah, as I said, the supply chain risk is very, very specific to few components, few electronic components. And certainly we being part of a global integrated supply chain, our ability to secure supplies is far better than many. And as a consequence, what we have been seeing is a month-on-month improvement. However, the constraint remains. That's number one. Number two, also, given the fact that the orders are pretty strong, even though we are able to secure higher allocations of some of these electronic components, our ability to meet 100% of the demand may remain constrained at least for a few months is what we currently see. But that doesn't mean on a sequential basis or on a year-on-year basis will not be growing. It's just the fact of how the level of order intake and the level, our ability to supply in a particular quarter or a month is.
Appreciate that. I'm looking at numbers and your commentary. Numbers are better than what your peer set has done. Your growth, if I compare with ABB, Thermax, Siemens, it's quite impressive. All those companies have given a guidance. While you're doing the best, yet you've not given a guidance. So is it like cautiously optimistic view, or you think that in the near term, the uncertainty is so high that you do not want to give a guidance?
I think what you said earlier is really where we are. I mean, we are cautiously optimistic given the uncertainty with respect to the supply chain disruption that we have, given that we are getting into a pretty significant emission transition phase. And number three, with respect to what happens on the macros as well as on the geopolitical. When you put all of these factors together, we just remained a bit more on a conservative side, and therefore didn't provide a guidance for the quarter as well as the year.
Appreciate your time. So glad you could join us, and look forward to see much more of you going forward. Well, Nouriel Roubini was in India, and he was at GBS, where my colleague Ajay Sharma caught up with Nouriel Roubini on where he feels India is headed. Now, remember, just to give a perspective to our viewers, Nouriel Roubini in 2007 called the GFC crisis. He really was one amongst the foremost economists who came out and said that, look, there is a debt crisis and the clock was ticking, and then it exploded. And that is the reason why he's one of the most sought after economists when it comes to forecasting. And his current forecast clearly seems to be that India could see a 7% growth in the medium term, and that could really make India as one of the fastest growing economy, at least of this decade.
Well, I'm quite positive about India. I think there is a good chance that India is going to be the most important country in the world over the medium long term. You have a population the largest in the world, young and growing, 1.4 billion people. So that can, with good education and skills, lead to strong economic growth. Secondly, there's going to be a catch-up of growth. The growth per capita of India is only 1/4 of that of China. With the right policy, growth can be potentially above 7%, and that's going to lead you to become a very strong economic power. And finally, the country is also going to become a major geopolitical power, both in Asia and globally, given its size, its role, and the fact that, you know, you need a strong power to manage the relation also with a rising China.
Nouriel, you've really analyzed business models, if I may say so, economic growth models of so many countries over decades. How are you really analyzing the economic development model which India has, is practicing and exercising last couple of years?
Well, in some dimensions, the economic model of India is similar to the other growth success stories. For example, the East Asian growth model was based on exports as a leading source of economic growth. In the case of East Asia, was traditionally manufacturing. In the case of India, until recently, has been more exports of services, IT, tech, and other services. But the export-led growth is actually one of the ways in which a country can become more dynamic and competitive. There are other ways in which the lessons of Asia also can be learned, because in parts of Asia, the economic model came one of using national champions. Say in Indonesia, there's Suharto, in China, there's Xi Jinping, the Keiretsu model of Japan, or the Chaebol model of Korea. For a while, actually, those national champions were a source of economic dynamism, But the reality is that over the medium term, when you have too much concentration of economic power among a small group of conglomerates, you are reducing potential growth because you are hampering innovation, you're restricting new entrants, there is not as much competition, and total factor productivity growth depends on having a very competitive sector. What's happening in India, for example, in the tech sector is one in which there is a level playing field. Any firm can enter the tech stack, allows new entrants, new unicorns to provide financial and other services. It's very dynamic, it's very competitive, it's very productive. I fear that in some parts of the old economy, the existence of very powerful conglomerates that represents, unfortunately, forms of crony capitalism is going to hamper economic growth. That's why the potential growth of India, in my view, is stuck around 6%, is not going higher, in spite of the policy reform, is really crony capitalism that keeps you behind.
India is trying to do a lot in a very small span of time, and challenges are very big. The way our policymakers, the way our regulators, all of them are working together in order to ensure that there is manufacturing-led growth. Our financial markets are very efficient. The way we manage the crisis, RBI managed, without throwing away money or handing over money in people's hand, we manage the crisis well. How do you see the role of all the stakeholders coming together to achieve larger objective of structural economic growth?
Well, so far I would say India has done quite well. Of course, in India, you have to have a coordination of a variety of policymakers and also regulators, not only at the union level, but also at the state level. The fact that there has been now, in the last decade, the creation of a fully integrated internal market that used to be divided, the demonetization, the introduction of the GST has helped that, and reducing other types of friction, building an infrastructure that is union-wide, that reduces the logistics and the cost of transportation is also very important. Those policy choices, of course, are more challenging in a democracy than they are in an autocracy. But as we know, autocracies make mistakes. You know, in China, Xi Jinping is not just the president, he's like an emperor. And last year he made massive mistakes in the management of COVID, bashing the private sector, not dealing with financial imbalances and so on. So while democracy is more messy, I think that you get much more consensus for your policy choices if it's through a political process where you can convince people of the right reform. Those reforms may take longer and occur more slowly, but they become more sustainable and more resilient over time. That's why a strong, vibrant democracy with a market system and the provision of public services, of a variety of things, the middle class and the poor, is the right economic approach, and that's the one that has been taken by India successfully.
You've mentioned friendshoring. Here in India, people are very excited about opportunities China plus one can throw up for India, or even Europe plus one is now being spoken about. How large opportunities could this be for India if Indian corporations really scale up their standards of manufacturing and scale? Is it like a decadal theme or even longer? Because large capacities and orders will start flowing here. How structural do you see this phenomenon?
Well, friendshoring, of course, is a huge opportunity for India. It's a large country, it's in Asia, it's an alternative to China. But I think that you cannot take it for granted. You have to have the right policy and regulatory environment to make sure that the capital that is leaving China is going to come to India. There are plenty of other countries, both in Asia and around the world, that could be sources of friendshoring, first of all. You've done a lot of work now to build the physical infrastructure that was lagging, the one of China. More needs to be done in that direction, but you're going in the right direction. The skills of the labor force are mixed. On one side, you have really a small group of people that are in the high-tech sector that are excellent, but the investment in education for the rest of the country need to be made in order to have the kind of skills for manufacturing at low or medium value added, let alone high value added as well. The business framework and the institutional framework is also important. Some sectors, some foreign firms came into India, and then advantage was given to local firms, say in the telecom sector. They got burned out and they left. So you have to make sure that there is a level playing field, that you're not making favorites for local oligopolies or monopolies or cronies or other national champions, other the foreign firms are not going to come to your country, or they're going to come and they're going to become disappointed. So it's an opportunity, but you cannot take it for granted. You have to work really hard in a world where capital is really mobile to make sure that the capital wants to go to India as opposed to other parts of Asia.
So you may have observed that our policymakers are taking a lot of steps to beef up manufacturing. PLI was one. In this budget also, we hiked capex overall and in railways. Do you think this is the right approach for infrastructure, manufacturing scale-up? For what else would be required to scale up our manufacturing capabilities to global levels?
I think that developing a manufacturing base is important, and having the right industrial policy is important. I think that, however, India is at risk of making some mistakes. Mistake number one is that attracting global firms that produce for this market is good, but you need also to have goods that are competitive in global markets. Instead, what's happening in India is that the attraction of foreign capital is used as a more like an import substitution industrialization. The restriction to tariffs on either raw materials, intermediate inputs, or final goods that imply that actually, if you're a foreign firm wanting to produce for the global market, if the imported inputs are expensive, you cannot exploit the global value and supply chains that are part of an integrated production process. So going in the direction of protectionism of domestic firms and of domestic industry as opposed to having production for export-led growth may be a challenge, and the fact that India has not recently joined either FTAs or regional trade agreements is a signal that you're doing something slightly not right. And the other dimension of it is the comparative advantage of India is not in traditional labor-intensive industries, not even in things like, say, cars, tractors, or locomotives. It's in high-tech, it's in IT. And within IT, there are products, of course, like iPhones and other types of tech products. Now, some of those productions may not be as labor-intensive as traditional manufacturing, but if you're going to give preference to your subsidy to more traditional manufacturing, you're not going to exploit your comparative advantage that is in technology. So I'm all in favor of industrial policy, even of subsidy and so on, but they have to be done in a coherent way that actually makes your firms and your products competitive in global market rather than in a protected domestic market. And that's one risk you're facing.
How have you analyzed the steps taken so far by our central bank in order to keep the currency stable, in order to manage inflation versus growth, tilting towards growth, while still taking all efforts to manage inflation?
So far, I think the RBI has done well. They thought that they probably were done with the last policy hike, 25 basis points in February. Unfortunately, the data about headline inflation and core since then have come slightly higher than expected, even if wholesale inflation is lower. There is a state of the world in which, unfortunately, inflationary pressure may be persisting, and therefore the RBI might be forced to hike slightly more and withdraw further liquidity if the world is a weaker one. And if the world is going to be one which will be financial pressure on the currency, on the balance of payment and so on, then the policy trade-offs are going to be challenging, because either you prevent the currency by essentially weakening by doing forex intervention that has cost and benefits, or you let the currency weaken. If it weakens too much, that may be a source of imported inflation, or you hike essentially policy rates in a way that weakens economic growth. I think that you have to manage it carefully. I would say that the margin, while the currency is weakened on a number of measures, say the real exchange rate equilibrium, probably there is still room for some depreciation, especially if you're thinking about having export-led growth, either of manufacturing or also of services. So a gradually falling currency may not lead to significant imported inflation, especially because some of your raw material, like oil and energy from Russia, is bought at not international market prices, but discounted prices. And the benefit of having a slightly weaker currency, like in the case of the Asian tiger, might outperform any kind of concerns about imported inflation. So maintaining a competitive currency should be actually one of the important objectives of the RBI.
Talking of currency, we are also trying to conduct international trade with a lot of partners across the world in our own currency, be it Russia, Iran, Africa, parts of Southeast Asia. Do you see that gain momentum?
Yeah, I'm on the view that overall there will be a process of de-dollarization over time. Part of it is just structural. The share of global economy of the U.S. is falling from 40 to 20%. Doesn't make sense for the U.S. dollar to be 2/3 of all international financial and trade transactions. Part of it is geopolitics. The U.S. is weaponizing the U.S. dollar for national security and foreign policy objectives. That, of course, makes the rivals of the U.S. uncomfortable, but even some of the friends and allies of the U.S., whether in the Middle East or even in Asia, are a little bit queasy about that. And you can see how the rupiah could become, for some of the trade that India does with the rest of the world, especially South-South trade, could become a vehicle currency, could be a unit of account, could be a means of payment, could become a store of value. Certainly, rupiah over time could become one of the variety of global reserve currencies in the world.
That's amazing. You have made a comment that India has the potential to grow 7%. McKinsey says it's India's century. Some other similar agencies say it is India's decade. When you say 7% plus is our potential growth rate, what's the durability of that? Are we talking about many years of around 7% growth? Is that possible?
Well, it certainly is possible. China, when it was growing very fast for 3 decades, it grew at about 10%. And of course, that with aging of population and catch up of growth once you reach middle income levels is not sustainable. The per capita income of India is low enough that actually with reform, certainly 7% is possible, but even more than 8%. But you have to do many more economic reforms that are structural to achieve that growth rate. And if you achieve it, you could maintain it for at least a couple of decades. But it depends very much on policies.
But at the same time, let's talk about some global challenges. Your recent book, Mega Threats 2023 Beyond. If I were to ask you, what were the 3 biggest threats would be that global policymakers, individual leaders of countries like ours, all of them have to bear in mind and have to make their policies anti-fragile, if I may use that word, that these risks don't hamper their overall plans at all?
Well, the one that is key, that is relevant for the world, but also specifically for India, is the issue of climate change. Under some scenarios, a good chunk of India will be maybe either underwater or too hot to live or subject to major natural disasters. So investing into the green economy, the green transition, making energy more renewable or alternative to fossil fuel is going to be very, very important to have a better planet and a better world. In India is as at risk as any other parts of the world. I think that's a key one. The nexus of overall macroeconomic stability, maintaining low inflation, maintaining sustainable private and public debts and external debts so that you don't have financial pressures that occur when you have excess indebtedness is going to be a nexus of economic that maintains macroeconomic stability is required for having also stable economic growth. And third one is really investing into the variety of capital, human capital, physical capital, infrastructure capital, institutional capital, and also global soft power as a way of achieving also sustained economic growth. The future of the world is digital, is knowledge, is innovation. The benefit of India is that it has already a comparative advantage in tech, and it can do much more so in those industries of the future, but good policy frameworks and implementation of them are necessary in order to achieve that particular success.